$48,800. That is the median price of a home in America right now. Not a penthouse in Manhattan. Not a beachfront property in Beverly Hills. The median, the dead center of the country on an average Tuesday. You are lying on the couch in a one-bedroom apartment that drains $1,470 from your account every single month. And you are doing the math. You are doing the math that doesn't work. You've run these exact numbers 3 times this week. The equation never changes. The answer never changes. You make $54,000 a year. You have $11,200 sitting in a savings account. You have a credit score of 694, and you have a student loan payment that hits your checking account on the 15th of every month like clockwork. The house you grew up in, the one your parents bought in 2001 for $148,000. It is now worth $390,000. You know this exact number. You know it because you check Zillow on your phone at 11 p.m. the way other people check Instagram. You check it the way you'd check a physical wound, peeling back the bandage just to see if it's gotten worse. It always gets worse. You tell your friends you're saving up. You tell yourself you're being financially responsible. But saving at your current rate means another 4 years before you even have enough for a standard down payment on something that might be worth less by the time you actually get there. The market is not waiting for your savings account to catch up. It has never waited for anyone. This is the exact spot where most people freeze. This is where they stay. Not because they lack intelligence, not because they don't work hard enough, but because they are optimizing for comfort when they should be optimizing for position. The two feel almost identical from the inside. They are not the same thing. You think you are trapped by your income. You are not trapped. You are just playing the rules of a game designed to keep you exactly where you are. And you believe it until you read a random forum post at 11:30 p.m. on a Wednesday. A post from a guy with no famous name and no credentials, talking about a terrifyingly simple math trick he pulled in Columbus, Ohio. It's 11:30 p.m. on a Wednesday. The blue light of your phone is the only thing illuminating the room. You find a post. It's not from a billionaire. It's not from a celebrity. Just a guy, no credentials listed, talking about a house he bought in Columbus, Ohio back in 2019. The price? $174,000. He put down $8,700. That's it. He rented it out. The tenant paid the mortgage. Every month without fail. 4 years later, he didn't sell it. He refinanced it. He pulled out $41,000 in tax-free equity. He used that cash as a down payment for his next property. You read the post 4 times. You check the numbers on your calculator. The math is not complicated. In fact, it is almost embarrassingly simple. You have spent your entire life being taught that debt is a cage, that a mortgage is a burden you carry until you die, that owing money is a moral failure. And here is this man, describing debt as an engine. Something shifts inside you. It's not a feeling, it's a framework. The first rule: at 0, your obstacle is not a lack of money. Your obstacle is that you are thinking about real estate the way a renter thinks about real estate, as a cost. The moment you see it as a vehicle, the whole road changes. You stop scrolling through Instagram. You start studying the market in your city the way you used to study for final exams. Except this time, you actually care. You learn what a cap rate is. You learn what cash-on-cash return means. You learn what DSCR stands for, and why it matters more to a bank than your actual salary when you're buying an investment. You learn the difference between a Class A building in a prime zip code with a 4% return and a Class B rental 3 miles away trading at 7%. You aren't ready to buy either of them yet, but you understand the difference. And understanding is always the purchase, before the purchase. Because 3 weeks later, a casual conversation in the break room at your job is about to change everything. You find the property on a Saturday morning, not on a glossy real estate website, not through a sponsored ad. Your coworker mentions it offhand in the break room while the coffee machine whirs in the background. Her aunt is selling a duplex. She's tired of being a landlord. She wants out. She needs to close before the end of the year. It's a 1960s brick duplex in a working-class neighborhood. A neighborhood that has been quietly gentrifying for 2 years. 2 miles away, a local hospital just announced a $200 million expansion. She's asking $218,000. The units are already rented, both of them. The combined rent is $2,100 a month. You don't go home to think about it. You run the numbers in your car, on the back of a greasy napkin from lunch. Then you run them again at home on a spreadsheet until 2 a.m. You try to talk yourself out of it for 4 days. You tell yourself the roof might leak. You tell yourself the tenants might leave. You tell yourself you're not an investor. Then you call her, you put 20% down, $43,600. That payment takes you to zero. Your savings account wiped clean, your safety net gone. You feel the way you imagine people feel jumping out of planes, terrified, and more awake than you've been in a decade. Your mortgage rate comes in at 7.1%. It's higher than what your neighbor paid for his house. That's how the bank plays the game when they know you aren't living there. Your monthly payment, including taxes and insurance, is $1,174. The units bring in $2,100. After setting aside a reserve for maintenance and the inevitable rainy day, you clear $486 a month in net profit. It is not life-changing money. You know it's not life-changing money, but you realize something that makes your skin crawl with excitement. 2 people you have never met are building your net worth, one rent check at a time. While you sleep, while you work your day job, while you're at the grocery store. But being a landlord isn't a movie montage, and 18 months from now, you're about to learn that the real profit isn't in the rent check. It's in something much more invisible and much more powerful. You do not quit your job. You do not buy a new car to celebrate. You do not even tell your parents the full details. You spend the next 18 months learning that passive income is a lie told by people selling courses. It's 7 p.m. on a rainy Thursday. You just sat down for dinner. The phone vibrates. It's the tenant in Unit B. The water heater is leaking. Not a drip, a flood. You don't call a fancy contractor. You can't afford the margin. You go to Home Depot. You learn what a P-trap is. You learn how to sweat a copper pipe in the dark, with a flashlight held in your teeth, while cold water soaks through your work shirt. You feel like a failure. You feel like a glorified janitor. You ask yourself why you didn't just leave that $43,000 in a boring index fund. But then, 18 months later, you look up. The neighborhood is changing. A coffee shop opens on the corner. Then a CrossFit gym, then a small brewery with string lights and expensive IPA. The hospital expansion you bet on, they just broke ground. You open Zillow. Not with a wound this time, but with a scalpel. The duplex you bought for $218,000 is now estimated at $261,000. You have $46,000 in equity. The cash flow has continued month after month. You've saved another $14,000 from your day job. You are 29 years old. Your net worth is $68,000. 2 years ago, that number was zero. 2 years ago, you were just a person with a couch and a dream. Now you are a person with a machine. The second rule: the house someone else pays for is the only house that makes you richer while you sleep. Everything else you own, your car, your TV, your furniture, is just stuff that is slowly turning into trash. You realize the $486 a month in rent wasn't the point. The point was the $43,000 in equity that just appeared because you had the courage to stand in the gap. You decide to refinance. You pull out $28,000 in tax-free equity. It feels wrong in your stomach, like you're stealing from your future. But you finally understand what that guy from Columbus understood. You are not spending this money. You are repositioning it. You are about to move from 1 duplex to 3 units. But as you scale, you realize the bank is starting to look at you differently. And to get the next deal, you have to stop looking like a borrower and start looking like a business. You drive the same car. You eat lunch at the same places. You sit in the same gray cubicle, listening to the same hum of the office photocopier. Nobody at your office knows about any of this. To them, you are just the person who makes $54,000 a year and occasionally brings donuts on Fridays. They see a salary, you see a bankroll. You've noticed that talking about what you own makes people strange. They either want a piece of it, or they want to explain to you why the bubble is about to burst. Neither conversation is useful to you anymore. You've developed a physical allergy to both. You find a 6-unit apartment building, built in 1971, all units rented. It's in a mid-sized city where the vacancy rate is 4.2%, and rents have climbed 2.9% annually for 3 consecutive years. The asking price is $640,000. The current net operating income is $41,200. You do the math, that's a 6.4% cap rate. In a national market where apartment cap rates are sitting at 5.7%, this isn't just a good deal, it's an anomaly. You don't rush in. You spend 6 weeks underwriting the deal from every possible angle. You study the plumbing records. You audit the utility bills. You find things the seller didn't disclose. A deferred maintenance issue in the roof. A tenant who hasn't paid in 2 months. You use those problems as a scalpel. You negotiate $38,000 off the price. You close at $602,000, but you don't use your own money this time. You've spent the last 8 months building a relationship over coffee and quarterly updates with a private lender. Someone who has capital but no time. Someone who trusts your math more than the stock market. You bring in $82,000 from them. They make 9% on their money. You get the building. Everyone wins. This is the transaction that changes the texture of your leaf. The third rule: below 5 units, you are a landlord. Above 5 units, you are building a business. The distinction is not cosmetic. The financing is different. The insurance is different. The tenant profile is different. And for the first time, you hire a part-time property manager. You pay her $340 a month. She is worth 3 times that. Your portfolio is now generating $7,140 in monthly gross rents. But as the numbers get bigger, the weight starts to change. You are about to hit a number that most people think is the finish line, only to realize it's just the beginning of a much heavier game. You are 34 years old. You own 9 units. Your total real estate holdings are worth $1.1 million. Your outstanding debt is $714,000. Your equity, your actual slice of the world, is $386,000. You've officially crossed the $1 million mark in assets. The number doesn't land with a celebration. It doesn't land with champagne or a social media post. It lands in your chest like a fist. It's not pride you feel, it's weight, the weight of having built something real, Something that existed only as a frantic, late-night calculation on a couch 5 years ago, and now exists in brick, in mortar, and in the lives of 9 families who call your properties home. You feel the weight of it, and then you do the only thing that makes sense. You get back to work. You sit at your office desk on a Tuesday morning. Your boss is complaining about the font size on a PowerPoint slide. Your coworkers are debating where to order salads for lunch. You look at them and realize you're living in a different gravity now. You file your taxes differently. You no longer use a generic website to file your 1040. You have a CPA who specializes in real estate. She doesn't just do your taxes. She navigates the Internal Revenue Code like a high-stakes chess player. She introduces you to cost segregation. You learn that the IRS allows you to depreciate a residential property over 27.5 years, but you learn how to accelerate that. You learn what a Schedule E is. You learn how your paper losses are quietly wiping out your tax liability, turning your tax bill into fuel for the machine. The money you save on taxes goes straight back into the engine. You are no longer an employee who happens to own houses. You are an operator. And then the phone rings. It's not a friend. It's not your mom. It's a developer you met at a networking event 6 months ago. He's overextended. He's bleeding cash on a construction boom that just stalled. He has a 24-unit apartment complex, and he needs it gone. This deal is twice the size of everything you own combined. If you say yes, you aren't just a landlord anymore. You are stepping into the deep water. The phone call changes everything. A developer is selling off a 24-unit apartment complex. He overextended himself during the construction boom. He's looking for liquidity. He's looking for a way out. The property is in a secondary market you've studied for 2 years. Growing population, expanding job base. The kind of place where remote workers moved during the pandemic and realized they never wanted to leave. The asking price is $2.8 million. The cap rate is 5.9%. Occupancy is at 91%. You know this market so well you can see the gaps without looking at your notes. You know that if you make 2 specific operational changes, that occupancy hits 96% within 14 months. But you have a problem. You cannot do this alone. You have never syndicated a deal. You don't even fully know what that word means in a legal sense. So you do something that feels like throwing money into a fire. You spend $4,000 on an attorney who does. $4,000 for a conversation and a stack of papers. It feels like a mistake, until you realize that in this game, you don't pay for information. You pay for the protection of your reputation. You reach out to your network. People you've been building relationships with for 4 years over quiet dinners and quarterly updates. People with capital but no time. People who trust you because you've shown them your track record instead of just telling them your dreams. You raise $680,000. You close on the 24-unit complex. You are now the general partner. You are a different version of the person who was afraid to call a woman about a duplex 6 years ago. That person is dead. This person is an operator, the 4th rule. The deal you get into matters less than the terms you negotiated to enter it. Equity, cash flow, and control are 3 separate things. Most amateur investors think they want cash flow. They want the check in the mail. But as you scale, you realize what you actually want is control. Understanding the difference between building income and building wealth is the difference between a job and an empire. Open loop, Mofong Lap. You are now 37. Your portfolio holds 47 units. Your annual net operating income is $310,000. After debt service, you net $148,000. For the first time in your life, Your real estate income has officially crossed your salary, but you don't celebrate because you're about to have a 3-hour conversation at a dinner table that will determine if you stay at this level or if you risk everything to cross the $10 million line. You sell the first duplex, the one that started everything. The 1960s brick building where you once sweated copper pipes in the dark. Your basis in that property, after years of depreciation, is $47,000. You sell it for $319,000. In the old world, you would pay a massive tax bill. You would hand over a third of your gain to the government. In this world, you execute a 103-1 exchange. You don't touch the money. You don't see the money. You roll the entire proceeds directly into a 32-unit complex in a market where rents are 14% below comparable cities. You are not buying real estate anymore. You are buying time. Your net worth crosses $2 million. It lands differently than you expected. You thought it would feel like an arrival, a finish line with a flag and a cheer. Instead, it feels like a checkpoint on a road that is much longer than you originally imagined. You start getting to know people who operate at a different altitude. Not celebrities. Not the people you see on TV. Operators. People who own 200 units, 400 units, 1,000 units. You watch how they think. Not what they own, but how they think. The pace is different. The patience is longer. They are underwriting deals years before the deals ever become available. They are building relationships with sellers before those sellers even know they want to sell. They are managing capital with position sizing and exit strategies built in before the entry is ever made. You raise a small fund, $4.2 million. The investors aren't strangers. They are 12 people who have watched you operate for a combined 11 years. They aren't betting on the property. They are betting on you. The fifth rule. At $10 million in real estate holdings, your reputation becomes a financial instrument. Brokers bring you deals before they hit the market. Lenders call you. Sellers take your offer over a higher number from a stranger because they know you close. They know your word is more reliable than a bank's pre-approval letter. That trust was not purchased. It was accumulated at the rate of one kept promise at a time, over a decade in a markets nobody else was watching. At 43, your portfolio holds 218 units. Total asset value, $31 million. But the numbers are no longer the interesting part. You are about to enter a room with 7 other people who control $2.1 billion. And you're about to learn that when you reach this level, you stop being an investor. And you start becoming infrastructure. You are 51. Your portfolio spans 700 units across 9 different markets. Total real estate asset value, $87 million. Equity, $39 million. Your net worth, including everything outside of brick and mortar, $52 million. The exact figure is known only to your attorney, your PA, and your spouse. That's it. You've stopped measuring yourself by the number, not because it doesn't matter, but because the number has stopped being the interesting part. The structure is the interesting part. The velocity is the interesting part. The way capital moves, compounds, and creates options that didn't exist in your previous life. You no longer manage properties, you manage an institution. Small, but real. You have a staff, an asset management team, an acquisitions director, an in-house CFO who oversees 13 different LLCs and 2 operating funds. The sixth rule. Above $50 million, you are not an investor. You are infrastructure. Cities plan around you. Lenders structure products specifically for you. The market doesn't overlook you anymore. It incorporates you. You are in a meeting room with 7 other principals. Combined, the people in this room control $2.1 billion in real estate assets. The conversations are short, the decisions are fast. The money moves in sizes that would have seemed fictional to the 27-year-old version of you, the one who checked Zillow from a rented couch. You are now in the middle of a 300-unit ground-up development deal. You have never developed from the dirt before, so you hire the person who has. You learn that the entitlement process is a graduate-level course in municipal politics and zoning law. A city council vote goes the wrong way. You lose 6 months and $500,000 in soft costs. You don't panic. You don't sell. You adjust the plan. You redesign. You represent. The project moves. The building delivers. 94% leased in the first 6 months. The city that fought you is now using your building in their economic development brochures. You do not feel vindicated. You feel focused. You make decisions based on fundamentals now. Prestige is for people still trying to impress someone. You stopped doing that the day you cleared your first million. You spend your Tuesday afternoons mentoring 2 people who remind you of exactly who you were 24 years ago. You don't give them motivation, you give them math. Because somewhere in this city, right now, another 27-year-old is doing the math that doesn't work, and you're about to tell them the one thing they aren't ready to hear. Real estate rewards the specific. The person who studies one market, one set of fundamentals, and one type of asset until they can see the numbers in the dark, that person is still at the table 20 years later. The person who is waiting for perfect conditions, they have been waiting this whole time. Somewhere in this city, right now, there's a 27-year-old lying on a rental couch. Their apartment costs $1,470 a month. They are opening Zillow and looking at a home priced at $48,800. And they are doing the math that doesn't work. They are telling themselves they are being smart. They are waiting for interest rates to drop another point. They are waiting for a crash that will supposedly hand them a fortune for free. The market is not pausing for your savings account to catch up. The 30-year fixed rate is 6.37% this week. It was 6.62% a year ago. It might go lower, it might go higher. The question is not whether the moment is right. The question is what the next 20 years looks like if you keep waiting for it to be. The machine doesn't run on confidence. It doesn't run on inspiration or hustle culture. It runs on the first small, terrifying, specific decision. A duplex. A phone call you almost didn't make. A down payment that takes your bank balance to zero. After that, someone else starts building your net worth. After that, the math starts running in the right direction. After that, you start understanding what the word asset actually means when it belongs to you. When it was built by your decisions. When it runs on a Tuesday afternoon while you are doing something else entirely. $48,800. It always starts there. It always will.